Okay, welcome to our webinar, everybody. Please follow the instructions and enter your audio PIN numbers. My name is Kevin Hill, and I'm an AmeriCorps Vista that has been coordinating the development of the San Joaquin Valley CRA Collaborative. The San Joaquin Valley CRA Collaborative is a newly forming organization that seeks to work with nonprofits, financial institutions, and federal regulators in order to further develop the San Joaquin Valley. The purpose of this webinar is to increase your understanding of the Community Reinvestment Act, provide an overview of how your organization can develop a CRA strategy that will benefit your organization, community, and partnering financial institution, and also to discuss a number of resources that can be used to assist your organization's CRA strategy and learn about the needs of your community. We are recording this webinar, and it will be available for future viewing shortly afterwards. Today we are fortunate enough to have Anna Castilla of the Federal Reserve Bank of Atlanta and Melody Head and Daryl Rutherford of the Federal Reserve Bank of San Francisco on the line. They will be presenting Understanding the CRA and How It May Benefit Your Organization, which will be followed up by a presentation by me that will detail the resources available to help your organization make use of the CRA and discuss the needs of your community. We will be concluding each section of this webinar with a Q&A session, so please submit the questions in the chat window during the webinar that you would like to hear discussed during the Q&A sessions. I will now turn things over to Melody.
Thank you very much, Kevin, and welcome everyone to this webinar. There will be an interesting discussion on what the CRA is about and how it impacts you. And I need to shut that noise off. Bear with me 1 second. Okay. So let's jump into, this would be on the slide entitled, What is CRA, Kevin, where we'll start about the statute, meaning the law, the U.S. Code. So the CRA was enacted in 1977 in response to widespread concerns that discriminatory and often arbitrary limitations on mortgage credit availability were contributing to the deteriorating condition, in fact, of American cities, particularly lower income neighborhoods. In the mid-1970s, a view was taking shape among certain members of U.S. Congress that attempted to explain the economic decline of inner-city neighborhoods through a process of disinvestment. According to this view, financial institutions that accepted deposits from households and businesses in these inner-city locations focused their lending activities elsewhere. In other words, there was a concern that certain lenders were redlining these areas. And so what does that mean? What is redlining? And in essence, it is where a lender makes a decision to not loan in a particular geographic area. And quite some time ago, in the 60s and early 70s, they would actually use a red pen on a map and outline areas where they didn't want to lend. So what happened then, it was systematic denying of credit based on perceived income, race, or ethnic characteristics of these neighborhoods, rather than the actual creditworthiness of borrowers who lived there. Once the credit flow dried up in the redlined areas, the next step was stagnation and depreciation of property values. Often higher income households moved out, lower income families moved in. With house value depreciation, neighborhood quality in terms of public amenities, schools, crime rates, and such other measures also deteriorated. This view therefore suggested that initial neighborhood disinvestment, i.e. redlining, led to future disinvestments until the community lost its viability. Broadly speaking then, as we go through this today, we're going to want to keep in mind that CRA is all about wanting to deter any kind of redlining practice. And in fact, I can share with you that it goes back a long way. I mean, there's evidence of it, blatant evidence of it, all the way back in to the 20s, in 1920s. But in 1933, a University of Chicago professor, a fellow named Homer Hoyt, published a theory that property values correlated to race, and that he ranked races in terms of positive to negative influence, scale of A through D, as far as influence on values. And it was pretty wild. I mean, you know, number one, the most least offensive people, I guess, would be the English, German, Scottish, Irish, and Scandinavians. Then it went down the list. You know, next was North Italians, and then Bohemians and Czechs, and then Poles and South Italians, until you got down to the bottom of the list at number 10, 9 and 10, which is where he had stated Negroes and Mexicans. And what's interesting is that he was later hired by the FHA to develop underwriting criteria for the federally insured FHA program. But that was a long time ago, and redlining was has been hard. It's a hard-fought battle. In 1964, the Civil Rights Act. From that point until 1977, when the CRA came in, it was a very long, hard-fought battle in many cities around the U.S. And so we have all of those community activists to thank for that, most of whom are, of course, no longer with us. So, in terms of the about the CRA, basically, regulators are required to assess the record of federally insured financial institutions, which basically means banks, not credit unions, but banks and savings associations, as to how they fulfill their obligations to the community. And for the Federal Reserve Bank, the CRA law implements the act is called the Regulation BB, part of what we call the alphabet regs. So I mentioned that the CRA applies to these federally insured, meaning FDIC insured, depository institutions that are basically national banks, thrift associations, and state-chartered commercial and savings banks. So the Federal Reserve Bank regulates bank holding companies and very few of the banks across the country. Most of them are regulated by the Federal Deposit Insurance Corporation, and they handle state member banks that are not part of the Federal Reserve System. And then the larger national banks are regulated by the comptroller. And when I say regulated, what I really mean is that we put them through safety and soundness and consumer protection, or what we might call CRA and compliance exams, on a frequent basis. If you want to know which regulatory agency directly supervises a particular bank, go into any branch and look at the signs, and you'll note that there'll be a sticker or a label that will indicate which agency is the primary bank regulator. And most often that information is pretty close to where the teller line is. So let's go on to the next slide, and just to make sure, I didn't do it on the last one, but this next one is talking about banks being evaluated based on asset size. There are basically 5 types of compliance categories, if you will, under the CRA. And what we're going to talk about today are the small banks, the intermediate small banks, and the large banks. And so they are rated according, or I should say they are stacked, if you will, according to their asset size, the things that they own. So right now, as of January 2013, small banks are defined by having assets under $296 million. So each year it goes up according to the, I think it's the Consumer Price Index, but I'll have one of my colleagues correct me if that's incorrect. So at any rate, the small banks are under $296 million, and the intermediate, I'm sorry, excuse me, that's right, under $296 million. And then the large banks, they are greater than 1.186. Everything in between that are called intermediate small banks. So our discussion today, as I mentioned, will focus on small, intermediate, and large banks, because that's who you're going to see and who you probably deal with most often. So let's go to the next slide. Why are CRA ratings important? So the regulators, in terms of understanding what a bank is doing and what the community needs, the regulators, back when the CRA was first created, wanted to make sure that the activities, future activities of a financial institution were governed by their performance, what they do under the CRA. So there's pretty strong implications if a bank does not comply with the CRA. So when we say take account of a bank's record of helping to meet the community credit needs, there's quite a bit that goes into that, into a CRA program for an institution. So what can happen if they are not in compliance? It's quite simply they are prohibited from opening new branches, meaning expanding, which is what their business is about, or perhaps engaging in a merger with another institution or acquiring one. And so there's some pretty strong implications, and when a bank applies to their regulator what's called an application for one of these functions that I just mentioned, can be turned down if they're not in compliance. So that's good information for you to know. So let's move on and take a look at the next slide, and that's about a little more on the CRA history. So the CRA is an act. And you know you've heard that saying about, oh, it takes an act of Congress. Well, it really does. To change an act, it takes a lot of money, time, and people. And so what happens when we need to adjust the impact of an act, which is called the regulation or the implementing regulation, we have the ability to change that, to update it. So the CRA regulation has been amended several times over the past 30 years, well, 36, right? 36 years old now, to maintain the regulation relevant to changing market conditions. The most significant change came in 2005, when the regulation enforcement guidelines were amended to focus on the impact of bank strategies and actions rather than simply the process. So in addition to defining the small, intermediate, small, and large bank asset threshold and compliance expectations, the regulation incorporated at that time a definition of disaster areas, distressed or underserved non-metro middle-income areas, and included that under what qualifies in the definition of community development. Now, back before 2005, CRA officers, they had a series of folders. They were called, I think we all had different names for them, but basically they were 12 assessment factors. And you got credit for attending meetings and sort of attempting to push things along, but really not having any responsibility, definite responsibility for the tracking, measuring, evaluating, and reporting out. And that's one of the most significant things that happened in 2005. Today it is all about impact. So you could say that what happened was the regulators, the federal banking regulators, moved banks from this discussion of form, meaning how they do what they do, to substance, meaning what impact does it have. And that's really where we are today. Let's go to CRA history. In 2009, CRA was updated again through guidance to include foreclosure response activity and several specific types of investment. And so this is the one where banks that contribute to remediating the foreclosure crisis, really, if there are neighborhood stabilization program funds coming down into the community, whether or not the bank actually engaged in the funding wouldn't matter. They would get credit under their CRA program and in their CRA exam if they participated in the area. So that was good news, but it's a good example also of how the CRA can be amended. And where we find these amendments are in a document called the Q's and A's, or the Q&A, the CRA Q&A. And when they come out, it takes a couple of years to actually get them developed and published, but they do have really good, solid information that you can have in this access through the Federal Register and also through the website of the FFIEC. And that's an organization that is a council, if you will, of the federal banking regulators. So let's move on to the assessment area and some key definitions. So assessment area sounds pretty clear, right? It's an area where the banks have their exam, the assessment of their exam, and it's where they do their work, where they, it's like a geographic boundary for them. So, so let's go over a few of the terms. So the assessment area is the market that a bank serves for CRA purposes, and it must consist of a whole geography or contiguous areas or political divisions with no gaps. So in other words, there's no redlining. The assessment area must include the bank's branches and the majority of lending or other activity undertaken by the bank. With respect to the assessment area, organizations can very much help banks extend their reach into targeted low-income communities by helping them with their bank assessment of needs. So a community needs assessment, a CNA, and that will affect their overall performance. So what we're going to be talking about more as we move through this webinar is this idea of collaboration and integration from both sectors. So let's move on to performance context. Now that one threw me when I first heard it. It was like, couldn't they just call it something else, something like one word that'd be easy for all of us to get? But when you think about it, it is pretty clear. The word performance means what they do. And the context is what's going on in that neighborhood. What are the demographic and economic trends and changes and perhaps challenges that they must consider. So in other words, context is really another word for stage or setting. So the performance context, as I mentioned, is the market overview that explains the bank's local economy, city development market factors, and general opportunities and challenges. The performance context is the detailed description of the assessment area from a community development perspective, and with particular attention to the bank's position in the market. So in other words, banks do what they can do given some of their own structural limitations and financial limitations. So let's go on to the next slide. Bear with me one second. Okay, let's go on to definitions of income. So under the CRA, what is considered low and moderate income is a dollar amount. It's a percentage of area median income for individuals and families based on a particular scale. And you can see what that is. So less than 50% of median income is low. And at 50, but less than 80, is moderate income. And above that is middle and upper income. And most of the work that's under the CRA then is going to take place with low and moderate income considerations of area median income. So for example, if we take a look at, let's just use the low income number, the 50%. If we look at Fresno, according to the 2012-2013 U.S. Department of Housing and Urban Development median income limits, and also they coincide with Fannie and Freddie, I looked at Fresno County, and that number is $55,500. So you can see that half of that number, 50%, has a definite low income nature to it, and it makes it very difficult for families, particularly families with children, to certainly be able to buy a home and oftentimes even obtain suitable, affordable housing in the rental market. So communities, bear with me a second. So I think I have more numbers on all the counties in California, so maybe in the Q&A, if anybody has any questions on that, I can answer that. So, and one other thing I should mention is that in the definition of the assessment areas, it's often the Metropolitan Statistical Analysis description, so the MSAs are often used. MSAs are counties. So let's go on to small business and farm key definitions. So it is important for us to note that the technical definition of small business under the CRA is different than the SBA's definition, and potentially the definition of small business and bank portfolios. So there are multiple definitions out there, but under the CRA, it defines small business and small farms as enterprises with gross annual revenues of under $1 million. Let's go on to community development. So aside from its normal product and service portfolios, banks may have particular products or underwrite specific loans for purposes that fall under the definition for a community development activity. So what are they? They include affordable housing for low and moderate income individuals, whether it's rental or single family. It includes community services targeted to LMI individuals, such as healthcare clinics, child care centers, charter schools, senior centers, and the like. It includes activities that promote economic development by financing small business or small farms, and it also includes this big category of revitalization and stabilization projects, typically ones that a local or state or federal jurisdiction has determined is a targeted area for redevelopment or reinvestment. So for credit for broader statewide activities, so if a bank decides that they have an initiative that they know of that's not within their assessment area, they are free to invest or lend in that area, but they must first show that their own area, assessment area, that the needs of that area have been met and that it really is their focus. So similar to nonprofits with a geographic focus, such as in a neighborhood, city, or region. So let's take a look at, and let me back up, on the community development definition. It really is one of the most important things that you can discuss with a bank in terms of the particular project or a project idea that you have, And what we look for is to see that 51% or more of a project is targeted for low and moderate income, and it fits within these primary 4 definitions. So there are materials available. One in particular is the Office of the Comptroller's fact sheet, and it's available online, and we can also provide it to it after this webinar. But it's really good because it spells out in each of those what are some pretty clear examples of what qualifies. So let's go on to qualified investment. There really are no predetermined amounts of investment required by banks. But everyone, you and the banks included, are looking for a benchmark or something that will help them understand what is good and what's better. In reality, the actual amount of what is required depends on a number of different factors, including the size of the organization and its condition, its financial condition, its overall capacity in the area, and technical expertise by the bank, the types of opportunities available, and other elements. Peer review or analysis can be a very helpful tool, giving an idea of what other banks have taken in a particular assessment area or market, and we will address more of that later. So banks are evaluated as compared to peers and compared to past performance. So what we're going to do next is we're going to have Ana Castillo lead us into the next series of slides, beginning with types of CRA examinations and exam types.
Thanks, Mel. It's a pleasure to be with all of you today. I'm calling in from Miami. And when I heard the Fresno income levels, it sounds like it's right about the same as Miami is. So just to give you a perspective, you know, regardless of population or the area of the country that you're from, some communities do have some things in common regarding their incomes and some of the distribution of access to financial products and lending and things of that sort. So I'm going to discuss just kind of some of the basics on how CRA compliance is examined for different types of institutions. And keep in mind that the idea behind this presentation today is just to give you kind of a baseline understanding of the process, of some of the definitions that are used in CRA compliance and regulation, and in pointing out to you where some of the challenges are for financial institutions and some of the strengths are that nonprofits and other partners can bring to the table to help compensate that, so that you understand how you can work more effectively with some of the financial institutions in your area under CRA for those types of activities that apply to CRA. So here we're going to start with, Kevin, if you can move to the next slide, with the different types of CRA examinations. And we're really going to focus on the retail bank exams. We're not going to look at wholesale banks or on the strategic plan option that banks have. The link that you have at the bottom of the slide is that ffiec.gov, that organization that pulls together all of the regulatory information on CRA and home mortgage disclosure compliance. And you can go on that site, find much more detailed descriptions of exam processes, of information that's reported annually on mortgage, small business, and other types of lending. And you can also find there, you can do a search for individual institutions and find a copy of their public evaluation, which we'll discuss later, but it's kind of like the report that discusses the evaluation of the bank's CRA compliance. And you can get a very good idea from looking at these PEs, which is what we call the public evaluation, of the types of activities that different banks are interested in, what they've undertaken in the past, where they seem to have an appetite or expertise for certain types of banking activity. And it might give you some food for thought in terms of who very good potential partners may be for your particular project or organization. We're going to go over these 3 exam types, which is the small bank, the intermediate small bank, and large bank. So on the next slide, please. One thing before going over the exam that I wanted to note using this slide is there are many nonprofit organizations that have asked about how they can become more involved or engaged in the exam process. both to point out those institutions that are making a very strong impact and a very positive outcome in the community through the work that they're undertaking, and those banks that some community groups feel are falling a little bit short in terms of meeting the needs or taking advantage of opportunities to meet needs of unbanked or underserved markets. So you can see here that the CRA examination and enforcement process is kind of a continuous process. Prior to an exam, there's a lot of communication that takes place. Consumer complaints are looked at in terms of how they may apply to fair lending and compliance with CRA. And also, we have examiners that on a regular basis, while they're conducting exams, go out and meet with nonprofit organizations just to get an idea from them regarding the performance context that Melody mentioned earlier, what the conditions are, what the challenges are, and what kind of activities banks are helping with. So during the exam process, while there's some analysis of the banking data and reporting that banks submit, there's also an outreach feature, and there's opportunity for nonprofits to make comments and to send in their perspectives on how banks are doing and where they would like to get additional assistance in partnering with financial institutions. We that work in community affairs do a lot of this through our outreach meetings, but we also have examiners that are assessing these kinds of opportunities and are making notes about this type of information. Most of those comments, the public comments, will be included in the public evaluation that the banks have, in their public file. And you can take a look at some of the comments or some of the types of information that have been received regarding bank compliance and performance in those files. The next slide, please. So the small bank test, and this is, thank you for correcting it, the new guidelines just came out for the asset sizes. So small banks are now 296 million and below. The small bank test is pretty cut and dry. It is a very data-driven exam where examiners will look at the deposits that the bank acquires from its assessment area, and then the loans that are made to that same market. So they look at that loan deposit ratio to make sure that most of the money is maintained within the assessment area. They also look at general lending inside and outside the assessment area and how that might differ in terms of the products that are offered or the types of loans that are made. The distribution of loans by geography, which refers to whether or not the loans are made in low, moderate income neighborhoods, and then the distribution of loans to borrowers by their income. So they look at the loans both in terms of how much lending is made in low, moderate income areas and how much lending is made to low, moderate income borrowers. Finally, they look at the responses to the CRA-related complaints. And another thing that they may look at with small banks is to look at their leadership and their engagement in general community and economic development types of initiatives and projects that are undertaken either at the government or at a neighborhood level to see how involved they are in both assessing needs and in developing responsive measures to serve those needs. Okay, the next slide. The intermediate small banks is kind of a growing range of banks throughout the country. So these are small banks that are on a growth track. They are between the 296 and now $1.186 billion dollars. And for intermediate small banks, one of the important things for those banks to take into consideration is that once a bank is growing, they really don't know, they can't manage when they're going to meet that or surpass that threshold in assets. So once a bank nears that $1 billion in $1 billion in assets, they should be developing a new kind of strategy and outreach program to develop the right types of contacts and opportunities to help them comply under the large bank exam. Because chances are that within a year or two, by the time that they're examined, that they will be looked at under the large bank criteria. So for our purposes today, we'll mention that intermediate small banks are largely looked at under the small bank test, but then they layer on top of that the community development test that we'll discuss in a moment, which refers to all of the lending and activities that are associated to those community development criteria that we just talked about in the definition. And then finally, the large bank exam, which is the one that most people, I believe, are familiar with, is for those banks over 1.18. We could say 1.2 billion in assets. And that particular exam is broken up into 3 sections, which specifically refer to lending, investment, and service. Next slide. So the lending test is going to look at the geographic distribution of loans. This is under the large bank test. The borrower characteristics, much like the small bank description that we had. We look at both the geographic and the demographic distribution of lending and activities. It's going to look specifically at community development lending and community development activities that support making credit available to target communities, and then the innovative or flexible lending practices that the bank has undertaken to be able to respond effectively to assessed needs in the community. The community development test requires that the loans have as their principal purpose a community development purpose as defined earlier, and also that the city loans are within the bank's assessment area. Now, for large banks that tend to serve a regional market or may serve a state, what is permitted for these particular financial institutions is to make investments or make loans to initiatives that serve a much broader geographic area that includes the assessment area. So, for example, you might have a financial institution that invests in a bond program for developing infrastructure in targeted communities throughout the state of Florida, in my case, or throughout Southern California in yours. And then within Southern California, their assessment areas would be within that geography. That type of lending and activity can get them credit. Next slide. One important thing is that a community development loan, if it's reported by a bank for consideration under community development, it cannot have been reported under any other kind of category that's looked at or evaluated for compliance with CRA. So the only exception to this is multifamily dwelling. In other words, if financing is made available to multifamily housing that targets low-income rental units, that can also be counted for community development, particularly if it's in low, moderate income area or provides all of the units provide affordable housing in that geography. So the examiner, when they look at community development, they're going to look at the number and the amount of the community development loans, the complexity and innovativeness of those loans, to what degree does the bank really have to kind of put on its thinking cap to look at how it's going to overcome some of the barriers or challenges to particular projects, the extent of community development services that are provided through that lending activity, and then the responsiveness to community development lending investment or service needs in that market. And with regard to the number and amount of community development loans or the complexity and innovativeness, that performance context and that peer kind of comparison is very important, because looking at what distinguishes one bank's activities versus another is usually what's used to define whether a particular type of product or particular type of service is really innovative for that market. Okay, next slide. So what we have on this next slide is just an example taken from an actual CRA exam. This was a $2.5 billion institution in northern Florida that serves Florida and southern Georgia. And you see here, we just underlined that this particular bank had increased its community development lending by 900% during the examination period, and that the majority of the lending had gone to areas, geographies, where students were eligible to receive free and reduced lunch. So that's one measure that can be used to define a low, moderate income geography or community development purpose loan. Businesses that provided jobs to low, moderate income people. That loans that to businesses that were located in enterprise zones or empowerment zones. So there was some type of measure that helped to define that they were community development loans. Now, one of the things that I point out to folks when we talk about this slide is, a 900% increase is pretty large. So an examiner will probably want to know, how did the bank do that? One answer to that may be that the bank developed a very good partnership with a really strong community partner that has developed a strong community development lending pipeline for the institution, or they have found a niche in certain types of lending that fall into community development and that have helped the bank make a lot of new loans. Now, the other thing is that sometimes banks fail to recognize that certain loans that they make would have fallen under a community development definition. So when that's brought to their attention, they correct that, and then by the next exam you see a large increase in their performance because they're capturing information that they had unfortunately not captured before. Next slide. The large bank performance standards on investments is something that I know that many nonprofits and even government organizations are interested in understanding. One important thing that we point out is that there's no magic number for a bank in terms of what's expected from them in investments in the community. However, that type of that peer analysis and looking at the general investments that are made in the community development type of sector within a market are all taken into consideration to evaluate the proportion of the investment that's made by an institution based on its size, its assessment area, and the types of business or expertise that it really focuses on. So the investment test, to count toward investment credit under CRA, they have to be qualified investments that are lawful investments or deposits or membership shares. And the reason we mention lawful investments is there's certain types of activities that financial institutions cannot undertake, certain types of investment structures that banks are not permitted to undertake. So depending on the type of investment proposal that's made to a bank, simply the structure may preclude them from participating in that particular type of investment. The investment must meet one of the 4 components of community development as defined earlier. And these are really being stretched quite a bit lately. Melody mentioned some of the Q&As that are coming out. Workforce development, job training, and things of that sort is one of the areas where we see CRA starting to branch out more now. Also in terms of providing health care services to low-income communities to stabilize the community. There's a number of activities that are beginning to be allowed to fall under community development. So it's really important to keep up with those Q&As to see how new and evolving areas of the industry may start to be more directly tied to CRA activities. The investments have to benefit the assessment area. And then the examiners are going to look at that dollar amount, again, the innovation and the complexity, the responsiveness, and particularly whether those particular types of investments are routinely provided by private investors. So is the bank really coming in and meeting a gap that is not met otherwise? That's a particular consideration now that many municipalities are dealing with funding issues, and there's many important activities in communities that would be eliminated if not funded by new sources. So this may provide an opportunity to identify some new investment chances for financial institutions. So on the next slide, let me just show you the an example of the investment description from the exam for that same institution we looked at earlier. And the reason that we put this example in here is that some nonprofits were saying, well, but what can I expect in terms of return on my investment of resources if I put together a big presentation, I go after financial institutions and I'm asking them for grants or for some other type of investment in a project or initiative. So just to give you an idea, again, remember this was a $2.5 billion institution. Granted, you'll see at the bottom of the slide that they got a low satisfactory rating. In other words, they just marginally passed the evaluation in terms of their community development investments, CRA investments. But notice that for an institution that size, their grants and contributions totaled under $200,000. So had someone come into this particular financial institution and asked for a $50,000 grant, in essence, without knowing it, they're asking for 1/4 of all of the donations that the bank had made in that year or in those 18 months. I think it's important to understand that financial institutions, regardless of their size, may have different appetites in terms of the types of commitments that they'd like to make in terms of grants or other types of investments. And I think that providing opportunities, different levels of opportunities for institutions may prove more beneficial to you in terms of giving them some options of finding what fits in with their particular plan for investing best. On the next slide, actually, I lost you on my computer. Okay, there we go. Okay. On the next slide, we're looking at services. So this is the third and final test, the evaluation of CRA services. And the most important thing that we always point out to community organizations is that the primary purpose has to be community development, but it's also required for the service to be associated with the provision of financial services to low moderate income people, or at least related to the provision of financial services, period. So the classic example that we have is Habitat Homes. The bank will get credit for making a loan to Habitat. The bank will get credit for providing financial education to the family that's getting a home through Habitat, but the bank will not get CRA credit for helping to build the Habitat home because there's no provision of financial services in that regard. That is purely goodwill, good corporate citizenship, but not necessarily a CRA activity. So in developing opportunities to partner with financial institutions, keeping in mind that all of the expertise that they lend on serving on boards, serving on committees that are looking at whether it's the financial management of the institution or developing financial education and outreach for consumers, all of these types of activities will count toward their CRA services. And then, of course, also making accounts and different types of deposit and non-credit products available to low moderate income consumers to promote financial stability, both for the family and for those communities. So on the next slide, we have an example of a qualified service description from that same exam. And I'll just point out that in this second paragraph that the bank is a leader in providing community development services. That's one of the things that is really important for examiners to be able to pick up on, whether banks have engaged in really looking for innovative and responsive solutions to assess needs in a community. So on the next slide, you'll see that in the end, there will be a an evaluation or rating that's arrived at for the institution's compliance, and it goes from outstanding, which is the strongest, to substantial noncompliance. Banks need to have the satisfactory outstanding ratings to be able to move through their applications for expansion and other types of growth activities. If they have a needs to improve or substantial noncompliance, there's going to be a lot of added requirements for them to even be considered for something like that, and chances are that they're going to run into some challenges in being able to undertake those types of activities. So let me just quickly go over on the next slide some of the CRA officer steps that they take in preparing for an exam. And I want to do this to lead into how a partnership with a community partner can really help them to prepare much better for their CRA exams and just do better in being able to convey information to examiners to be considered and evaluated. So you see here that the review of the exam request letter is done by the CRA examiner right before the exam begins, and they're asked to submit a number of different documents and information to the regulator. It's very important for the CRA officer to really know the bank's assessment area. So going through that performance context exercise, preparing a performance context for the bank is very important because that allows them to really understand and to kind of put in order in their own mind the priorities in terms of the needs of whether it's unmet credit needs or the needs of unbanked individuals or whatever type of community development and economic development types of needs exist in the community, which are the top ones that they really want to focus on, first of all, and which ones they want to make sure that the examiners are aware of. So making sure to help a bank in that performance context process is very important so that everyone's on the same page in terms of what outcomes should be the goals for the bank's strategy in helping to meet community credit needs. And the performance context is really a requirement for the large banks, but we encourage all the banks, whether they're small, intermediate, or large, to go through that exercise. This is kind of a market analysis to put their bank's CRA strategy together. On the next slide, let me just mention that in addition to, knowing the bank's primary product, which is easy for a banker to do, the important thing is to tie key products to responding to those assessed needs in the community from a CRA perspective. So again, making sure that a very good description of the assessed needs is available to tie back to how the bank is developing products and communicating or conducting outreach to promote products in the community to meet needs. That's very important. So let's go to the next slide.
Anna, I'm sorry.
What are some good CRA opportunities for banks then, based on our brief discussion of the exam requirements?
Sorry,
yeah.
Could you actually go over that last slide one more time? Your audio kind of started to cut out. It's fine now, but if you could just go over the last slide one more time.
Oh, sure. Yeah. Okay, so we were talking about the importance of documenting assessed needs in the community. So you see the second bullet of knowing the bank's primary products. What's important for the CRA officer is not only to know the products, but to be able to tie those products and how those products are promoted or targeted toward meeting the assessed needs of underserved neighborhoods and individuals in a particular assessment area. Because what the bank needs to do during a CRA examination is kind of tie everything together and say, well, we assessed needs, we developed a strategy for which needs we thought we were going to be able to respond to most effectively based on our product line and our banking expertise. We develop these products and outreach or promotion strategies, and this is the impact or results that we've obtained. And it's really important to show that kind of progression of a real management plan in terms of both implementing and tracking or measuring CRA compliance strategy. So partnerships with community organizations can be very valuable in helping to piece those things together into one cohesive strategy. So next slide, please. Thanks. So for small banks, you know, mortgage, small business for low, moderate income individuals. Many small banks tend to be in, I should say, many rural markets tend to have small banks, smaller community banks that are kind of an anchor in that community. So for smaller banks, one of the things that we emphasize is that there's a lot more flexibility sometimes in terms of the types of products that they can develop or the types of partnerships that they can undertake. But of course, some small banks have a few barriers or challenges in terms of their asset size, the size of a loan that they can make, the level of expertise that they have in the more complex types of products, and then also their ability to acquire capital and to really expand some of their lending activity. For large banks, it can, you know, they can look at broader regional markets, and of course, large banks may be making a $5,000 to $10,000 grant may not be as cumbersome with a you know, putting in the application with a large bank as it is with a small bank. But the types of relationships can be very different, and the appetite for participating in certain types of activities can be very different. As an example, I know that Bank of America has just gone through, I think, I wouldn't say rebranding, but they've kind of targeted their foundation dollars into education, workforce, and I forgot the third area, but they have very clear areas that they're focused in now. So if those are areas that you're going to work in, that might be a very good partner for you to develop. But if you cannot come to an understanding about, you know, a mutual definition of benefits through your strategies with their targets, then perhaps another type of institution or another institution would be a more logical partner for you. So it's really interesting to look at the past performance evaluations for financial institutions and to also have discussions with them, not just promoting whatever project you have, but kind of hearing out what kind of interest they have in terms of developing community investment or lending opportunities also. On the next slide. So this slide is intended to kind of give a perspective, you know, from a banker's perspective. What is it that they're looking for in partners on their side? One of the things that is very, very important to financial institutions is capacity. Because as Melody mentioned, banks don't really get that much credit for trying anymore. They get credit for delivering. So if a bank makes a commitment to invest or to lend or somehow partner with a community group to respond to a particular community development need through any particular initiative or product delivery or project, it's really important that they feel that the organization has the capacity to see that project through to fruition and to really deliver on that partnership as intended. So they're definitely going to look at the proven performance of an organization to undertake certain types of activities. This may be challenging for some nonprofits that are starting to venture into new areas so that they can go after new funding or so that they can meet needs for their community because another agency perhaps has gone out of business or has stopped providing certain services for a neighborhood. But a bank may want to know, well, does this nonprofit have the capacity and the experience and the kind of a proven track record to be able to undertake this type of activity successfully. Another thing that they consider is sustainability. Can the organization sustain itself over at least the life of the project, but hopefully even further out, so that they can undertake new initiatives as necessary within a neighborhood, and are they not necessarily depending on just the financial institutions, donations, or investment to keep them going. Assessment and responsiveness. Does the organization, the nonprofit, or the government agency undertake its own needs assessment and track its responsiveness to those needs? That's really important because that's kind of what the bank is being told, that by partnering with this organization, they're going to be able to fulfill CRA requirements, and they want to make sure that those that the needs are being assessed correctly, and that the projects that are being put in place are actually responsive to those needs. Innovation. Is the organization an innovative organization that is also flexible and looking at new ways of tackling issues and of dealing with barriers or challenges? Is the organization really going to be able to help the bank target a particular market segment that they need to go after? So this is particularly true for some smaller banks that don't have as wide a branch network as the large banks. If they need some help in reaching some of the borders of their assessment area, is there a nonprofit partner or another community partner that can help them get out there and build those relationships that they need? And then the record keeping and accountability is really important, because the CRA officer is going to have to turn around and provide that kind of record keeping and measurement to the examiners for consideration. So if a partner can help them with that, that's very important. Next slide. Keep in mind that these are some of the greater CRA challenges that banks experience on a regular basis. And to the extent that a partnering organization can really help in minimizing or mitigating these challenges, it just adds value to that potential collaboration. So as I just mentioned, the documentation of eligibility and impact, capturing income data for related activities, being able to show that the people that benefit or that participate are actually low, moderate income, ensuring that the activities fulfill the intended outcome. That's a real challenge for banks, as I mentioned earlier. Training and technical expertise in development programs. Sometimes bankers are not really up on low-income housing tax credits or what's happening with SSBCI programs for small business in the different states or municipalities. So a nonprofit partner can help keep them abreast of what's happening with these programs and with policy. Adequate documentation for underwriting. This is particularly true in processing loans for low and moderate income individuals, especially in mortgage and small business. Sometimes a nonprofit partner can really help to get all the information that the bank needs to even make the credit decision. So there's a number of different opportunities that nonprofits have to really leverage their own resources and skills and the niche that they've developed to really bring a lot of extra value to the partnership from their side. And then finally, on the last slide, I think this is the last slide I'm going to, oh no, I have two more. The bank decision factors, they're going to look at whether projects or entities serve the assessment area, the risk involved in working with a particular organization or a particular type of project, the cost to the financial institution. Yes, they mean well and they want to be responsive to community development needs, but they're also running a business, and the costs have to be in line, as do the risks, with safe and sound operation from a banking perspective. They want to make sure that they're responding to assessed needs, that there's a business skill alignment with the bank. Very rarely are you going to see a bank become involved in the project where they're being asked to provide any type of banking product or service that is really outside of their wheelhouse. That adds a lot of risk from the financial institution standpoint. And the leverage. They want to see that they're layering their support into a number of different resources and funds that are being brought into a project or a program, and not that they're the sole provider or the primary provider of the resources. The value to the overall CRA strategy or portfolio of taking on a new partnership or a new type of project, is this really going to help them show some leadership? Is it going to be a more visible or more effective type of endeavor on their part to really make a difference from a community development perspective, CRA perspective? And then the business development potential. Not only are they providing mortgage loans, but can they now develop some deposit accounts, perhaps later on some investment accounts, and things of that sort with individuals that are brought to their institution through the partnership with you. So I mentioned the public file, and on the next slide, you'll see that the public file for all institutions has, they have a full file in the main office, and then they have a file in one office in each of the states that they serve, depending on the financial institution. They have a limited file in each one of their branches. I suspect that many financial institutions, it's been a long time since I've asked for a public file, but many of these may be electronic now, and you might be able to even request them electronically. But they will have a description of the assessment area for the financial institution, a copy of their most recent evaluation, a copy of comments that they've received on their CRA performance, the list of branches, the list of some of the services or products or projects that they've undertaken that they consider to be particularly, very tied to CRA compliance or community development, and that map of their assessment area. So you can use all of this to get just a basic understanding for each one of the financial institutions in your areas that you serve or that you work in, of what their interest and what their assessment area and where their branches are, so that you can get just a fundamental understanding of that bank's operation. So now I'm going to hand it off to Daryl. That's going to talk about developing a CRA strategy.
Well, thank you very much, Anna. That was really great. Melody, I really appreciate both of you. This is a great opportunity for us all to collaborate throughout the system. Something we try to promote with everyone in the communities we work with, and we also are attempting all the time to figure out ways to collaborate. Before I do, though, Kevin, I believe you have a few questions out there, and I think since we've heard so much, before we get lost into some other details here, maybe we can go ahead and address those.
Sure. Frank Ruiz submitted a question on the chat box where he was curious if the, and Anna kind of answered this in the chat box, but maybe go into a little more detail. He was curious if the HUD definition of low income is different than the CRA definition of low income.
I can take that one. This is Melody. Yes, there is definitely, and as you had addressed it, that the it's probably worth mentioning that in terms of coming up with the annual income changes, the U.S. Department of Housing and Urban Development issues annual estimates that update median family income from the metropolitan and non-metropolitan areas. And so median income itself means that place in the middle where half the people in a county or an MSA earn less and half earn more. But so what HUD does is they start with the most recent U.S. Census data and factors in information from other sources to arrive at an annual estimate that most closely reflects the current economic conditions. And then what HUD does is they adjust it for family size. However, for CRA and for Fannie Mae and Freddie Mac purposes, we don't do that. Anna, would you have anything to add to that?
No, the only thing that I would point out, which we haven't mentioned, is that one big thing that happened in the last 3 years was that for any type of activity that's associated with neighborhood stabilization programs, the income is allowed to go up to 120% of the area median income and still be CRA eligible. So when it comes to NSP type of activities, that's one big distinction that we sometimes forget to make, but that is very relevant right now, particularly in our two markets where there's a lot of property that's being rehabbed and put back on the market.
Great, thanks. Lupe Felix is curious about where he can go to get information on how to get a CRA performance evaluation. I believe that may be covered in the next portion, but so I think we'll just table that.
Yeah, Kevin, this is Daryl. We'll be addressing that here shortly. Thank you for the question, Lupe.
I have one question. This is for Anna. You mentioned that the definition of community development under the CRA is expanding. Do you know of any reason why they've decided to expand the definition? Can you elaborate on that a little?
Yes. So just like the regulatory amendments that came about in 2005, as Melanie alluded to, we have 3 different regulators that have to come to a consensus on how they're going to make changes to regulations for their institutions. And the application of the regulation from small to large banks, differs quite a bit. So there were hearings held in 2010 across the country by the Federal Reserve in collaboration with the other regulators to kind of get an idea of how we could amend the CRA regulation yet again to make sure that we're keeping up with the changes in the market, and particularly with changes in those targeted communities that have low and moderate income populations. And there's been a lot of I guess, discussion about the best way to undertake some of those amendments. So in the meantime, because the market is dynamic and changing, some changes are just being incorporated through the Q&As to be able to take in, for example, this last one that I just mentioned about the neighborhood stabilization program. That's something that came about after foreclosures, and after the foreclosure wave. So in order to be able to incorporate a new program that was coming on that had very clear, ties to CRA and community development.
I'm sorry, and I'm having some difficulty hearing you.
Oh, I'm sorry. Is this better?
Yeah, that's much better.
Okay. So in order to keep up with some of the new programs that are coming out and some of the new things that are happening in the economy, particularly that affect low and moderate income areas, and not to hold up CRA completely, those kind of changes are being put into expansions in the Q&As until the 3 regulators can decide on how to make more definitive changes to the regulation itself.
I'd like to add to something that you said, Anna, about what occurred to me was, earlier you were giving the example of the bank that received an outstanding rating, and here was the comment about how one of the indicators of qualification would be in an area, if they were banks making investments and the students there are eligible to receive free or reduced lunches. What I find is interesting is that the examiners at the 3 banking regulators, they don't always think alike. So you could have a bank that's an FDIC-regulated bank, and they move to say, the Federal Reserve, and the examiners are maybe looking at different things, or they're taking different interpretation on things. And so that's one of the areas where I heard from the OCC that they don't always accept that as an indicator, and they look for more than just that, where the FDIC perhaps might say it's fine. That's a fine indicator. Do you find that happens on exams? I think you're a little closer to them than we are.
Definitely. Another area where it comes up consistently is in how investments outside of the immediate assessment area are considered. In some cases, one regulator will say, well, we want to see that you meet all the needs in your area first to our satisfaction, and then we'll count anything outside. And others interpret as you can make investments anywhere as long as it includes the assessment area. So it does depend. And I would just say that, for the non-bankers that are listening in on this, that is definitely in the bankers' area of responsibility. They can communicate with their regulators and, get better guidance on how things are going to be considered. However, if, when we talk about innovative kind of responses and just brainstorming on how to get over some of these challenges, that's where community affairs staff can be helpful in kind of looking at some of the options or alternatives that may be more effective in order to meet current needs. And then even discussing that, convening a discussion with examiners to then give some consideration to that. And I think that in many cases, that is how many of these Q&As have come about, because they've had enough questions or issues raised in a particular area where finally they decide that they need some kind of consensus on how they're going to deal with it.
Thank you, Anna. Is there time for one more question from, can I ask one more question, or are we short on time? How are we doing?
I think in the interest of time, we should move ahead, and you can bring it, when Daryl finishes his section, there'll be another Q&A session.
All right, great, Kevin. Thank you. So again, I want to thank everyone that's joined us today. I'm looking at the list of names, a lot of people I recognize, but then a lot of new names on there. So I really appreciate everyone participating in this webinar today. Definitely we'll be sending out all of our contact information, but for those of you that are within the Central Valley, I would be the point of contact for these efforts. If we do have anyone in the Los Angeles, Southern California area, that would definitely be Melody you touch base with. And then we have a colleague up in the northern part of California as well, and that's Lena Robinson, who would be the point of contact there. But you're welcome to approach all of us with any questions, thoughts, concerns. And if we're not able to provide you with the answer, we'll direct you to the right person. But moving forward here, I would like to just thank you all again for joining us. This next session is about developing a CRA strategy. And really what we want are the CBOs who are here to understand the importance of how to approach banks for funding. You should definitely be approaching banks similarly to the way you would go and write a grant or some other type of proposal to a foundation. It's going to entail a lot of research. You'll need to understand what your organization itself wants out of this and what type of partnership you're going to want to develop with a financial institution. And then also understand that it's okay to approach financial institutions with thoughts and concerns about your organization itself and how you can become a better partner. So with this slide here, you really, again, like I said, you really want to know your community. Research is key. You basically want to do your own performance evaluation, your own performance context by knowing the bank's assessment area. It's going to help you develop that strategy that will highlight a lot of the key community and economic needs, okay, that context that Melody was talking about earlier. So some of the research you want to do around community needs, you want to really ask yourself, what's the local economy like? Is it a fairly homogeneous economy that's driven mostly by agriculture and government? A lot of the counties here in the Valley, those are the two mainstays of employment. You also want to consider unemployment rate. Look at the small farm and business activity that's happening, as well as the technical assistance and access to capital needs of those industries. You also want to think about affordable housing issues, or just general housing issues in general. What are they like? Are households cost burden? Are they spending more than 30% of their income on rent or mortgage payments? You want to look at home ownership rates versus rental rates. What does that look like? Understand how foreclosures are affecting your community. Think about housing price trends. Are they increasing or decreasing? And, and then ultimately, what are the credit needs of your community? All of this is going to be very beneficial as you begin to develop your strategy itself. You'll also need to understand your community's demographics, population size, and whether or not you're going through some recent growth or a decline in population. You want to understand what the composition of the communities are like, the race and ethnicity, household types, family and non-family households by gender of head of households, or even the presence of or absence of children. Really pay attention to single-parent households as well. All of these are great details that you'll want to have on hand when you're approaching a financial institution while you're developing the strategy. You also want to look into what's happening in the public realm within your communities. What are some of the public plans and initiatives that are going on, and how can you leverage those activities or even partner with them? Earlier, Anna talked about the Neighborhood Stabilization Program. Does your local government have one? Is there something there that you can really build off? Again, that's the program that's for local governments to purchase foreclosed properties. Are there other opportunities you can do by partnering with the local government that will help you meet your community's needs? And then address the financial institutions as to how their funding can help leverage those activities. You want to know about other local community-based organizations. Basically, you want to understand your own market, right? You want to know who are some potential partners and allies, and you also want to know who could actually be considered competition. Some financial institutions are going to fund other organizations that are doing similar work as you. This might be a great time for you guys to develop some new relationships, collaborate more on projects, bring your strengths to the table, and really maximize the limited funding that financial institutions have towards CRA these days. Whenever possible, you also want to form coalitions. If you know your CBO market, you'll have a better understanding of who you can invite into your project to form a coalition and leverage their resources, their expertise, their staffing, all of the above. It's a great time for you guys. This is a great opportunity for people to learn new ways to collaborate. Again, banks are looking for impactful projects. If they see collaboration, then they're going to understand that there are going to be more strengths at the table that will help them maximize their funding. And by any means, they can eliminate duplications. You don't want to recreate the wheel, but you want to figure out ways to add value to the processes that are already underway. Next slide, Kevin. So as you think through these next 4 steps here, these are the basic 4 steps at developing the CRA strategy. You want to refer back to this basic section of this workshop, keeping in mind all the different criteria there are for the different sized banks. And you got to remember, not all banks are going to be created equal under the CRA. It's imperative you know that who you're talking to. Is it a small bank or large bank? What's their business model? Are they a commercial bank or retail bank? Do they prefer small business lending over mortgage lending, etc.? Those are all of these are the types of things you need to know. You want to do some research on the prior CRA performance evaluations. At the end of my presentation, we will give you a list of some resources, and then of course Kevin's going to go into some more greater detail on those. However, you should visit the Federal Financial Institutions Examination Councils, which Melody alluded to earlier. At their visit their website and bookmark it. It's ffiec.gov. Pretty simple, straightforward, a lot of great information there. Go ahead, Kevin, next slide. So understanding the CRA evaluation criteria is really key. We went into a lot of detail earlier about how the different sized banks are evaluated. For small banks, you're looking at assessment areas, dig into their public files, look at some of the complaints that might be filed there as well. All of this stuff is public information, and it definitely needs to be addressed during the performance evaluations. Keep in mind that small banks, it's just the lending test. So again, loan to deposit ratio. Are they lending inside and outside their assessment area? What's the geographic distribution look like? What's the borrower distribution? For the intermediate and small bank evaluation criteria, again, assessment area, you need to definitely know what their assessment area is. Are they, lending in one county and not the other, but then, for instance, in Fresno, but then they skip Madera and are up there in Merced? So really understand where their assessment areas are and where to focus. You have access to their public files as well, which contains all of the information that you need to understand what's going on there. However, the intermediate small banks, they're on a lending test, so a loan to deposit, what's happening inside their assessment area, geographic distribution, so on and so forth. They also will have the community development test. So again, you're looking at qualified investment, community development services, and loans. Finally, the large banks, they have all three tests. You have the lending test, the service test, and the investment test. And again, the investment test will involve the community development test, which we've discussed earlier. Again, always review prior CRA performance evaluations, which can be found at the FFIEC .gov website. Next slide. So when assessing the bank's performance, you really want to, the performance context, you're really going to look at a number of things. You want to think about their capacity and their strengths, and of course their business model. You know, if you're looking to do financial education workshops or activities, and you approach a bank that's really focused on small business, they're going to deny your request. So again, you really need to understand what their business model is and realize that, you know, CRA is definitely a great opportunity for financial institutions to build a new business model or strengthen their business. So again, use that to your advantage when you're approaching banks, that this is good for the community, it's going to be good for their bank as well. Earlier I mentioned about understanding the local economy and some of the demographics. You know, this is a great opportunity for you to track all this information. You know, look at newspaper articles, dig up, you know, look at some of the websites that have a lot of information on things. But definitely track all of this information, including the housing stock, cost, income levels, and all of that. Kevin, I think we have some interference on the lines. I'm not quite sure where it might be coming from, but I'm hearing a lot of information, a lot of interference here.
Okay. What I'll go ahead and do is I'll go ahead and mute Anna and Melody.
Okay. Another key point to this, and we alluded to earlier, is understanding what some of the local revitalization plans are. You know, there's a lot of information online these days that you have access to. The HUD consolidated plans really give you a good sense of how funding's being used in local communities, how the federal dollars are being spent. You can figure out ways that some of the projects that you have going on can be leveraged through these consolidated plans. So again, use that information when you're approaching the bank so that they can understand, oh, well, you know, this limited funding I am being asked to give is actually going to leverage a much larger initiative that's in place. There's also the Federal Home Loan Bank, you know, and we get this a lot. There's always a lot of confusion between the Federal Home Loan Bank and the Federal Reserve Bank. We're two separate entities. Federal Home Loan Bank is a membership institution of financial institutions, and there they have access to a lot of different programs that can be leveraged. You have the affordable housing program. You have some IDA programs. There are a lot of different things that could be, you know, that a financial institution can access funding through the Federal Home Loan Bank. So understanding whether or not an institution is part of the Federal Home Loan Bank system and has access to that thing, to that funding as well. And then, of course, understanding your community credit needs. A lot of different ways of doing this, but you got to take you know, all of those needs into consideration. How many unbanked folks are within your communities? You know, what are the credit needs for that? Do they need more car loan credits, you know, versus mortgage lending? So that kind of stuff you want. You also want to develop a peer analysis of similarly situated institutions. You know, this is kind of a controversial point here, but it's something that you definitely need to think about when you're approaching a bank. What else is happening in your community? How are you doing things versus your peers, so on and so forth. And then catalog the community development opportunities to lend, invest, or provide services. You'll definitely want to provide examples and anecdotes from the populations you serve. You know, let the financial institutions know that, you know, we worked with this particular household and these were some of their concerns and needs, and it would be, you know, this is how our project is going to address those needs with your funding. And lastly, a competitive analysis. What are the other banks doing? When you're developing this type of analysis, you'll really want to research what the other banks with similar asset size, structure, and market characteristics look like. You can find online what's called the call report, and basically if you go to the FFIEC website, you can ultimately get there, but what I'd suggest you do is just Google the FDIC call reports, and it will give you a link that will take you right there. You can then start researching what's happening with some other banks that are similarly situated as those that you're about to address. This information is used by the bank regulators pretty extensively, but it's also accessed by Congress, state bank regulators, researchers, and of course all of you, the public. And it's another way for us to really do some checks and balances here within this banking system itself, and can ultimately benefit your request for funding. Next slide. When you're assessing the community credit needs, again, you want to review all the written reports and publications on credit needs that are out there, and the programs that are serving low to moderate income families. The Federal Reserve System, we have a great research team throughout the country. The banks, each reserve bank has an economic research team. Even within our community development departments, we have researchers. So there's a wealth of information coming out of our institutions. The FDIC does some really good research, as well as the OCC. They have lots of publications on credit needs and programs serving low to moderate income families. You'll definitely want to be knowledgeable of these reports by entities that specifically research and analyze policies. You have the Community Reinvestment, the National Community Reinvestment Coalition. You have the New American Foundation. You have Policy Link. There are a number of organizations out there who've done a lot of research on this kind of stuff, and it'll give you a better sense of some strategies and other activities that you can, potentially adopt that will help meet the needs of your communities. And then think about some of the areas that are least served by financial institutions. Where are some opportunities that may be great, that could really be a benefit to a bank? For instance, West Fresno, I think, is a real untapped market. A lot of attention being brought there, a lot of great work going on in those communities, but high levels of concentration of poverty, right? What's really needed there, our folks pay attention to what's going on. Some services to, access more services to banking. And I know that there are a number of groups that have been addressing this situation. But again, it's, understanding those areas could also benefit you, because then you can go to a financial institution and say, hey, look, let's take a look at these communities. These are what some of the needs are. Can we just, think about ways of addressing it? And then, of course, comparing and contrasting products and services, by different banks that are serving you. Again, there's nothing wrong with saying, oh, hey, Bank X, I realize that Bank Y is providing these type of services to our senior population. And when we've had discussions with our seniors, they've mentioned that you guys don't necessarily have the same types of products and services. These are be a great opportunity for you to expand some services, get some new clients, build up on your businesses. So again, really think about what's happening out there in the markets, understanding that, and using that to approach banks. You can always visit a local branch to get this information, but sometimes not everybody within the branch itself are the right people to be talking to. They might not even understand what CRA is. It's definitely not unheard of for someone within a branch not to know what the Community Reinvestment Act is. Okay, so don't be intimidated by it if they don't, have an answer for you. Be patient, work your way up the chain, and try to find the appropriate answers you need. Next slide. When matching the bank products and services with your community credit needs, Be sure you understand what the bank's lending focus is. Again, knowing the economic and performance context is going to be key, what products and services that they're offering to the communities you serve. And definitely think about what's happening locally through the government loan programs. These are resources that are going to really enhance your ask. It will be leveraging opportunities. And it actually will help to minimize the risk that a financial institution is taking if they know that the federal government is already investing into an initiative of sorts. So again, banks are here for profit. They're also asked, by regulators to minimize risk as much as possible. And if they're going to go out on an innovative project that's yet to be proven, they want to know that there's limited risk involved. And if there's a government loan program that's underwriting an initiative or can leverage this funding, you definitely want to be sure to point that out. Next slide, please. So again, not all financial institutions are going to have the same goals and objectives when approaching CRA. During the housing boom, it wasn't unheard of for financial institutions to, pay more money for a low-income housing tax credit. That was actually going to be a loss to them, a minimal loss to them, but yet for them to really meet their CRA goals, they needed to be a little bit more competitive to that. And so instead of, paying, 85 cents on the dollar for a tax credit, they were more willing to spend 95 cents on the dollar to do it. All right, so you need to understand what are the goals and objectives, especially when it comes to lending. Mortgage lending, small business, farm lending, consumer lending, and even community development lending. Again, understanding the qualified community development investments, there's a whole section within some of the CRA guides that will provide resources to you here shortly on that go into what qualified community development investments are. But then, it's real imperative that you kind of have a better sense of what that is. You also want to think about community development financial institutions. Those are other areas that banks can invest into. It's basically a nonprofit bank, right, who provide a lot of lending services to low to moderate income communities. But, really can be kind of like an extra arm of a financial institution, a larger one that's, your more traditional type of bank. Community development financial institutions can break their expertise is doing small dollar loans, especially for like small farm practices. In Fresno, you have Fresno CDFI, who's done a tremendous job over the years as meeting the needs of their community, and in fact, one of the fastest growing CDFIs I've seen around in a while, and have been doing a pretty decent job there. And then again, services, qualified community development services. One thing I think financial institutions get a little bit discouraged in when being approached by CRA opportunities are that banks, or I should say CDOs, are unwilling to actually talk to them about what other types of services they could provide to their organization. There's a lot of experience and knowledge within financial institutions. And so, maybe you want to bring a banker on board on your board of directors to help you with understanding all your financials and things like that. There are other ways that they could provide services to you as well. Maybe you're putting together some kind of a financial education workshop series. You can partner with them for them to come out and actually teach those courses to your community. So a lot of different ways that you can approach banks to help meet different services there within your community. Next slide. Again, really understand and communicate the role and function of CD activities, what products generate revenue, what are some of the initiatives that the bank that can expand a bank's market. Getting involved in some of these bank-on initiatives would be really key for some financial institutions. But again, they're really going to look at things that are going to mitigate and minimize the risk that they're going to be taking on as they think about funding your CRA strategy. Always need to consider costs, not only to yourself but to the financial institution. Some of the banks, it might not be the bank's strength to go into this new realm, so for them to develop a new product and service, it could be pretty expensive. Also understand, maybe they've just announced a loss as well, right? What an awful time to be coming to an institution to ask for funding when they've just announced a loss to their stakeholders there. So again, really knowing and understanding what's happening there is going to be key. Last slide, Kevin. So again, strong CRA strategy. It's a well thought out plan. It's not something that's just done on chance. And ever so often you might be at a mixer and you might run into a banker and be able to explain, some of the products or some of the services you have to offer. That's a way into the door, but you should not rely on that alone. You still need to do your due diligence. You need to have a strong strategic plan put together with data, okay? Anecdotes are nice, but they need to be supported by data, all right? The bank's going to be able to use this data as well within their performance evaluation or during their examination, and it's just going to strengthen your guys' relationship as well. Again, it's founded on facts and research. It's not going to be, you can't approach someone on emotion alone, all right? And then be sure you understand what their business model is, because again, if it fits within that, they're going to be more likely to fund that particular effort and not necessarily turn you away. Maybe they've been thinking about expanding a new business plan or adopting a new business plan, and you're just coming in and helping them think about ways that they could get out into the community to better fit the needs. So, think about all of this stuff. Have some open conversations. I definitely would not suggest, you just walk into a bank with a plan and say, hey, look, I want to do this. You need to get to know your banker. You need to get them to understand your organization, your community, what's happening there. Build a relationship based on facts and research and your goals for the community, and start working one-on-one to really meet those needs. By the end of the day, hopefully they'll have a better understanding of your strengths and be more willing to fund your activities. So with that, if there are any other questions, next slide here, there are a number of resources here. I think that there were some comments going on, although I didn't quite pay attention to them. But you can see here, we will be providing this information to you guys. You have the FFIEC website. You have a guide to CRA data collection, the HMDA reporting. We have here a link to the Dallas Fed's CRA guide. Again, that's where I was talking about finding the qualified investments and all of that kind of stuff in there. And then what was mentioned earlier, the CRA Q&As. Correct me if I'm wrong, someone, but I believe there may be a more up-to-date one now. 2009, I'm not too sure on that. But with that, kind of leave it there. Kevin, if we want to take some questions, great. Otherwise, we can jump right into your resources.
Okay. We'll take some questions. I'm going to go ahead and unmute Melody and Anna for the question portion. Lupe Felix asked the question, how do you determine what are the bank's investment practices? Well, there's going to be a lot of stuff within their performance context itself that's going to give you a good sense of what they've done in the past. You'll also want to look into some of the public files, understand what information's within there, and even just carry on a conversation with your local banker. Find out from them what it is that they're looking for. Melody, Anna, you have anything to add to that?
Yeah, I mean, I think that what they're willing or looking to do with investments may differ a lot between different types of opportunities, different types of investment structures, and different types of projects. So one way to find out, of course, is if you see them listed as a sponsor investor, you know, in another community project or with another community organization. If you have a relationship with that organization, you could just find out about, you know, what their partnership with that financial institution consists of. But definitely, I encourage you speaking to the banks directly because, you know, that's a reasonable question to ask, and it just helps you to get to know one another, and you might find some opportunities to be able to benefit just from that discussion.
Thanks. Lupe Felix had another question, which was sort of answered in the chat, but we go over here. How do banks determine / decide what their assessment area is?
That's a really good question. A lot of times it's going to be dictated by where branches are located within a particular geography, where they're drawing deposits from, and you know, it's going to mostly be, you know, through a conversation based from the regulator, the bank's regulator, as well as the bank itself. Sometimes it's going to be dictated by the regulator strictly. Other times it's going to be in consultation with them. But Anna, I think you have a lot of experience in this realm as well. So
yes, and I actually posted that response. So when banks apply to be chartered to do business in a particular market, generally they describe their market through the county or city delineation, or it might be the state. But when we look at CRA compliance and evaluation, we look at the MSA delineation that's used by the census. So the county delineations have to kind of be transposed to the MSA. And at that point, the bank has to decide if they're just going to go with the whole MSA or if they're actually going to restrict to certain census tracts, which becomes a lot more cumbersome. In my experience, most banks will just go with the larger MSA unless they are definitely restricted by the branch network or there's some other barrier or challenge to them being able to service the entire MSA. But as I mentioned, you know, management is encouraged to look at that assessment area for CRA purposes on a regular basis. Sometimes their business starts to develop in geographic concentrations that they hadn't necessarily planned on. That may drive their application to open up a branch in that area. But in the meantime, then, you know, those are areas that they should be considering for CRA purposes. And they might want to start expanding the assessment area to be sure to include them because of the activity that they have. So it's kind of a dynamic, ongoing process, and they're just encouraged to stay on top of what their activity is inside and out so that they're really representing the best delineation of the area that they serve.
You know,
oh, go ahead, Melody. I'm sorry.
No, I was just going to say, I think I would add to that in some areas, like say, for example, Los Angeles County, it's so big, right? And if the bank is a regional or community bank, if they're a regional bank, they'll likely take the county. But if they're a community bank, they may only be able to support half of that county or a certain, you know, following some contiguous lines or political boundaries that are drawn. But it's a really good thing for you to do is to pull down a public evaluation report, and you can go to the ffiec.gov website to find them, although they're also on, like, the Fed, for Fed examinations, they're on our website. And I think maybe even all are on all three of the banking regulators' websites. But anyway, the point is that if you were to pull down one of the public evaluations for a bank that you have some concerns with, and ask the CRA officer for an informational interview, and say you want to have a conversation around their assessment area, so you can better understand that and how it was determined. And also in geographies where banks do have branches and are taking deposits and are making loans, some of them are examined at a lesser degree than others. And that's called a full scope exam versus a limited scope exam. And as I understand it, in 2 banks in the Valley, Fresno is a full scope exam area. So Anna, do you want to talk to the difference between those two?
Right. Well, certain geographies are weighted differently when it comes to evaluation because of the population or other factors that really kind of comprise the market in that particular geography. So particularly with regional banks, what examiners may do is that they may just pick a couple of the MSAs in which the bank does business from a, or I should say instead of MSA, let's use the same term, assessment area. They'll look at some of the assessment areas throughout a region, and they'll just pick a few and examine compliance in those particular areas rather than going into every single one. And they'll use that as the foundation for the overall evaluation results. But that's for the larger institutions. For the smaller ones, as Mo was saying, it might be true that a bank can only cover, reasonably cover, a portion of an MSA or a county. If that is the case, one thing that we encourage banks to do is to be very precise and very thoughtful in how they determine how they want to dice up that MSA so that they're sure not to eliminate low and moderate income populations or minority populations, without thought of the potential impact on their failed lending and CRA compliance.
If I can add one thing to that, this topic about risk, where we mentioned in the slides here that a bank's decision, one of the factors is about their perception of risk. If you don't know it already, banks are risk avoidant, definitely. When they look at an initiative that they're going to maybe provide a grant to, or if they're looking at a loan, they're looking at as best as they can, determine what they think the risks are inherent in that transaction, and then they seek to mitigate it. They don't automatically say no, because they're in the business to make loans, and they do want to support their CRA program. So know that banks are risk averse, and that they are typically not the first one to come in. So you have to find a bank that's willing to be the first one, and in other words, to be the first adopter, and then other banks will follow. But I think in terms of risk, the thing that's important to mention here is that as much as banks avoid risk, the community-based organizations, the nonprofit communities, they live with risk every day, right? That's what you do. You live with risk. And so you can have conversations about that. And you can also offer what you think might be mitigants or things that will make that risk acceptable to a bank. And it might be that you're working on a transaction that involves a percentage of equity or a percentage of ownership that the bank is looking for you to have and you don't have it. And so one way to mitigate that would be bring in a partner. Or maybe it's when you have an initiative you're working on, but your experience in that area, your perhaps management capacity and knowledge is limited. So you can partner with another organization. So there's lots of ways to talk about risk, so don't shy away from it. Just face it on, and oftentimes the banks will help you to determine what would make them feel more comfortable.
Yeah, Anna and Melody, I greatly appreciate both of you getting online today and providing your experience and expertise to all of our partners from throughout the Valley. I'm just now sending my contact information through the chat. We definitely, I think, need to move on and let Kevin wrap us up here with his resources presentation. But any other questions, folks, feel free to email me, give me a call. If if I don't have the answer for you, we will definitely find it in a short amount of time. But I know Melody and Anna are going to hopefully stay on here for the rest of this. And if we have any questions coming up through the end of this, we'll be happy to answer them. Thanks, Kevin.
You're welcome. Okay, I'm going to go ahead and mute so I can get rid of some of the interference. Okay, good morning, everybody. Really quick, I want to thank Melody, Anna, and Daryl for providing that excellent information. And I would like to talk with all of you about the information that is available to help nonprofits learn about and discuss the needs of your community. I've organized the resources I'm going to present to you in order of nonprofit sector that the information will be most helpful for, and there will be time for questions and answers when I'm finished. So please keep submitting questions in the chat bar. And we are recording this training, and it will be available shortly for repeated viewing. I will start with resources that will be helpful for affordable housing organizations. The Federal Reserve puts out info on the housing and labor market trends in California, with sections highlighting what is going on in the San Joaquin Valley. These reports are useful because they contain information on national trends, which allows you to make comparisons between what is going on in your community with what is going on in the region as a whole. And it also provides visual representations of the variation in foreclosure activity throughout the state. Here is a map of from this report of concentrated foreclosure activity in the San Joaquin Valley. You can see a fairly heavy concentration of foreclosure activity, and this map will be available later if you want to look at it again. But for specific information on foreclosure activity, you can use foreclosureradar.com. Foreclosureradar.com has a great deal of information available for free. If you simply go to their website and you click on the Stats and Trends tab in the upper right-hand menu, and from there you can access a ton of information on foreclosure activity in your state, county, city, and even down to your zip code. Really quick, I will show you an example of this. So you'll click on the link provided, and then you'll see the site right here. Go to Stats and Trends, and then I'm going to, for the sake of an example, I'm going to enter my zip code, 93704. Hit Enter, and give it a second to load here, and then you'll get your information. I can see that in my zip code in the month of January there was one notice of default. I can see that this is 92% less than the prior month and the prior January 2012. If I scroll down, I can also see that there were I can also see that 2 houses went back to the bank in January in my zip code. That there are 118 properties considered to be in pre-foreclosure, meaning that they have received a notice of default but have not yet been scheduled for sale. I can also see the average number of days between the filing of a notice of default and a property being resold by the bank or time to foreclose or being resold to a third party. It's for the bank, it's 148 for my zip code. This information would be helpful for a nonprofit that was trying to establish that your community or neighborhood was experiencing a large amount of foreclosure activity. This information is updated monthly with a tiny bit of delay, you can see, because it's still in January and we're early March. But it's fairly reliable. It goes as far back as a year for free, and you can access more information if you want to choose to buy a membership. But you're able to get a very good deal of information using this website for free. Okay, there are also multiple price indexes out there that allow you to assess the cost of housing in your area. The Housing Price Index is calculated by the Federal Housing Finance Agency, and it captures the quarterly movement of single-family housing prices in your community. This website also gives you the option to compare up to 3 different MSAs side by side. The National Association of Home Builders and Wells Fargo publish the Housing Opportunity Index every quarter. This measures the percentage of all homes sold that are affordable to median income earners. You can follow that link provided to download an Excel spreadsheet for free that has this index for all 8 Valley MSAs. In many MSAs, you can get this information as far back as 2000 if you download that Excel spreadsheet. The California Association of Realtors publishes the First-Time Buyer Housing Affordability Index. This measures the percentage of households that can afford to purchase an entry-level home. They have information available on the regional and county level. Unfortunately, not every MSA is included in this report, but it is still very valuable. This index information is helpful for determining trends in affordability and whether home ownership is getting harder or easier to access in your community. I'll give you an example of how this data can be used to establish this need in your community for more affordable housing. Let's look at housing prices in the San Joaquin Valley during the housing bubble. I'm going to follow the link provided for the Housing Price Index. Once again, remember this will all be available to you afterwards. And now, when I get to this site, I'm going to click on City HPI Data. And then it's going to give me an option to enter 3 MSAs. I'm going to enter Fresno, Bakersfield, and Stockton. Not only are these the 3 biggest population centers for the San Joaquin Valley, but they're also the center, south, and north of the San Joaquin Valley. Stockton. All right, start search, and then it's going to give me my data. If we look through this pretty quickly, you can see that about 2003, we start to see these consistent double-digit prices. It really seems to peak around 2004, where they start to get into the 20s and 30s. Remember that this is monitoring price change every quarter, which is 3 months. So this means that these houses were selling for this instance for Fresno in the fourth quarter 2004, 26% higher than it was selling about 3 months ago. And then we can see things start to get ugly around 2007 as we start to see the negative double-digit price activity. And then 2008 really appears to be maybe the worst of the recession in San Joaquin Valley. If you notice that Stockton's housing prices almost plummeted 40% in the third quarter of 2008, which is pretty astronomical. And then you can see that it starts to kind of level off in 2010, and in 2012 we start to notice some moderate growth. This data would help establish how damaging the housing bubble has been on housing prices in your community. Another resource for affordable housing is HUD consolidated plans. These are plans that identify, if you follow this link provided in the presentation, you can get access to the HUD consolidated plans for a number of Valley cities and counties, as well as the entire state of California. And these plans were mentioned earlier in the developing a CRA strategy portion. And they are very helpful because they detail the local housing and community needs of your community. And they also detail how HUD plans on addressing these needs, which is useful to nonprofits that might be looking to enhance their lending opportunities, such as was discussed earlier in the developing a CRA strategy portion. Another resource for affordable housing is building permits. The U.S. Census Bureau publishes information on the number of building permits issued in a given month at the state and MSA level, and even on some county levels. This tells you the number of building permits issued for each number of units. For example, if you wanted to know how many building permits were issued for a 3 or 4 unit housing structure in Merced in May 2012, that information would be easily available here. It'll also give you the value of the housing units permitted to be built. This information would be useful for a nonprofit that wanted to compare the current level of housing construction to before the recession or during. It's also useful for tracking the inventory of multifamily housing units, since you can see how many units were permitted to be built compared to the number of single units. Now I'll turn to resources that would be better for small business and small farm organizations. There are a couple of different sources that you can turn to get really great analysis of the economic trends in your community. The University of the Pacific Business Forecasting Center releases a quarterly economic forecast for the entire state of California and many other reports throughout the year with a special focus on issues affecting San Joaquin County. The Business Forecasting Center does great work. Unfortunately, to get access to their data, you must pay about $250 for a subscription. However, they do offer a reduced price of $125 for small businesses and some nonprofits. Fresno State has another great service called the San Joaquin Valley Survey of Business Conditions. This is a report that they publish monthly, and it's available for free and entirely focused on the Valley. The usefulness of an economic forecast will depend on the reality of the situation. If your community is going through a time of economic hardship, which unfortunately many of the Valley's communities are, then economic forecasts such as these can be highly useful since they can provide facts and analysis that will help you build your case that your community has a need for small business development. If you want to get specific information on unemployment for Valley MSAs, you should turn to the Bureau of Labor Statistics. If you follow the link in this presentation, you will be directed to a page specifically about California. From there, you can get information on the size of the civilian labor force, the unemployment rate, and employment info by industry. You can also get historical info, which will allow you to compare the current unemployment rate to rates during and before the height of the recession. Unemployment information is useful for an organization that is trying to secure resources for small business financing or workforce development because it helps you establish a need. SBA.gov is also an important resource. This page that I provide the link for on the SBA website has a good deal of information available on small business loans and grants. If you remember during the developing a CRA strategy portion of the previous presentation, it was recommended that organizations use government loan programs as resources to enhance lending opportunities and lower the risk of lending to your organization. Well, this site would be a resource for small business and farm organizations looking to do just that as part of their CRA strategy, because it provides a good deal of information on the particular programs that that the SBA is offering. Now we will turn to info for social service organizations. The informational needs of a social service organization will vary according to the service you offer, but regardless, there is probably information that would be helpful for you on American Fact Finder. American Fact Finder is probably the most comprehensive and accurate collection of statistics you can find. One of the great things about American Fact Finder, kind of similar to the Foreclosure Radar website, is that you can get data on your state, your county, city, and even your zip code level. I'll show you an example of this. Say I wanted to know how many people graduate from high school in my zip code, which would be helpful for some organizations that focus on a particular neighborhood and are interested in improving educational performance. I'll follow the link provided. Give it a second here to load. Okay, so I follow the link provided, and I get directed to this website. Once again, I'm going to enter my zip code, 93704. I'll hit Enter. For my purposes, since I'm interested in how many people graduate high school, I'm interested in education for this example. I'm going to click on the survey entitled Education, Marital Status, Relationships, Fertility, etc. Okay, and then I'm going to be greeted with a ton of information. And if I scroll down to educational attainment, I can see that in my zip code, 20% of the population 25 years and over has a high school diploma. This particular survey also allows me to get information on veteran status, the U.S. citizenship status of the foreign-born population, language spoken at home, and that's just this particular survey. There's many other surveys available on this website, so you can get access to a great deal of information for free. And now I'll turn to resources for financial counselors. The FDIC has prepared a very in-depth survey of the and underbanked. Unfortunately, this survey doesn't provide information about any Valley MSAs, but it does provide highly detailed information about the and underbanked in California and in the nation as a whole. This report would be highly useful for learning about the demographics of the and underbanked population. Scarborough Research also has a free study out that has information on people's banking behavior. The study is a little more accessible than the FDIC study, and also contains consumer information on unbanked individuals, such as what media they watch and even their spending habits. Another nice feature of this report is how it ranks the unbanked top markets. I pulled this from that report, and by looking at this chart, you can see that Fresno in 2011, according to Scarborough Research, was ranked second in unbanked top markets, with about 17% of the market considered unbanked. And then you can also see Bakersfield at number tied for fourth with El Paso, Texas at 10%. Both of these reports are useful for organizations that want to establish that financial education and mainstream financial services are lacking in your community, as well as providing information on the best way to market to the underbanked with the Scarborough report. That's the end of this part of the webinar. This entire webinar will be available shortly. It will either be available on our website, www.sjvcra.com, or sent out via email. I really hope you found these resources helpful for learning about and discussing the needs of your community. And I will now open up for questions. Okay. I see I have a question from Leslie Reese. And it says, will we be able to print the slides for all of these very useful resources? I'm fairly positive you will. You'll definitely be able to access this again for repeated viewing. And yeah, I could even send out an email of the slides. So yes, you will. And feel free to contact me after the fact, after we send it out to everybody, if you have a problem accessing certain things. I see that we're also running, we're a tiny bit over time, and so I want to thank everyone once again for coming today and attending. And if there is no further questions submitted through the chat bar, then we can consider this adjourned. I'm going to unmute really quick for Daryl and Anna and Melody, just if they have any closing statements they would like to make. Daryl, you're unmuted. Anna, you're unmuted. And now, give me a second to find Melody. And Melody, you're unmuted.
Oh, go ahead, Daryl.
Well, I just again want to thank everyone for taking time out this morning. Know a lot of information that was covered. Again, the CRA is a very complicated act. We hope that we've provided some better understanding of it. Again, we don't expect you all to walk away as experts on this, so please contact us with any questions, thoughts, concerns you might have. But again, I do appreciate all of you coming on. At some point, I think I saw we had up to 40 people online. Great to hear and see. I know that there were probably a couple that were on the phone as well, so thank you for those of you who were on the call. And with that, I'm going to say hope you all have a great day. Thank Anna and Melody again, and let you guys have some last words.
Yes, I just wanted to say, thank you for inviting me, and Kevin, for your participation. You've done a really wonderful job. And for the audience, just remember that it's through collaboration and integration of people and resources that you actually build capacity. And in terms of the list, this resource compilation that Kevin has given you is really great. And you want to make sure you have that and make a list of others that you have that you want to use, because when it comes to needing research, you need to know where your tools are and have them handy. And that's about it. Thank you very much.
Okay, everybody. Thanks a lot, and we'll be working on getting this to you very shortly. Bye.
Goodbye, everybody.
Goodbye. Thanks.